Alrighty, good afternoon, and welcome to the fourth installment of our Protecting Your Financial Future Money Monday series. My name is Katie Combs. I'm the Adult Programming Librarian for the Fort Worth Public Library, and I will be instructing today on how to better protect your financial future. So I'm just going to share my PowerPoint really quickly so we can get started. If you have any questions at all throughout the presentation, feel free to post those in the chat. I will glad to be able to help you with that and make sure that we are all on the same page. I'm also going to be referencing a toolkit. You can access that toolkit on our website. So if you go to the Money Monday series page on our Fort Worth Library website, you can download all of our toolkits that we have referenced in today's and past presentations. I will also post my email in the chat below at the end of the presentation. If you would like to email and request a copy, I can send it to you via email as well. So protecting your financial future. We are going to discuss on the module today, we will be discussing savings accounts as well as retirement accounts and any other child investment accounts, and just a basic of different ways that you can protect yourself and your family and your financial future. We will go ahead and get started. So what is savings? So savings is money that you set aside today to use in the future. So if y'all want to post in the chat, feel free to post in the chat of any kind of unexpected expenses or emergencies that you may need to use savings for. Now, these can be things such as car repair. You could do medical bills, anything else. Y'all are welcome to post anything in chat, and we can kind of get a discussion going on that. Pretty much anything. And these are things that, we talked about the last couple of weeks. These are things that you might be tempted to use a credit card for, or a payday loan, or anything like that to cover if you do not have the cash on hand. So it's really important to build up a good savings account so that way you don't have to tap into that credit card or payday loan and accrue that interest. So these are some examples of unexpected expenses or emergencies that you may need to use your savings for. So this is a tool that is in our toolkit that I referenced earlier. It is a savings plan. So you want to start first by picking a reason to save. So this may be an emergency fund, which I believe we referenced a couple weeks ago. Emergency fund is usually 3 to 6 months of expenses in case of job loss or income loss of any time. You would also save for a new car. You could save for a car maintenance fund. You could save for property taxes, subscriptions, anything like that. So what you would want to do is you would pick a goal. So let's say you would like to pay your car insurance in full. Now, car insurance the cost varies, but say it's $1,000 every 6 months. It's a little pricey. So you would like to save $1,000, and you would have 6 months to save that. So what you would do on this toolkit is to pick a savings goal here. You would say total amount needed for $1,000, weeks to reach the goal, which in this example, they are saving for an emergency fund within 10 months, which is about 40 weeks. So they need 40 weeks to reach the goal, and this is the weekly amount that they need to save, which is $25. So this $1,000 may seem like a really large goal to save, but when you break it down into these really easy chunks, you realize, oh, okay, so that's just $25 a week, or that's $50 a paycheck if you get paid bi-weekly. So this is, to keep in mind, really great tool to break down your savings goal and find out the best way to really do those bite-sized chunks in order to create a larger goal. Now, this down here is brainstorm strategies for saving. So these are, switch from premium cable to basic, and that will save this much amount. So this is the same example up here with the $25 a month. So they switched from premium cable to basic, which allowed them $10 extra a week. And they cut down on eating out, which allowed them an extra $15 a week. And that projected savings was $25 a week, which is what we needed up here. So feel free to get that goal on here and then brainstorm different ways that you can cut back on your expenses and spending. That way you have that extra money to throw at those savings. This is really great. I suggest everyone, especially since we're going up on a new year, to sit down or out in January think about all the things that you need to pay for that you would like to pay for in full and when those are due. So these are things such as maybe your Amazon Prime subscription or your car registration inspections due. These are dates that you know I will need this amount of money at this specific date. Now, instead of waiting and have those expenses sneak up on you, you might want to look ahead and kind of figure out, okay, if I set aside $10 a week, I will have my Amazon Prime subscription completely ready to go to be paid in full in March. So these are things that you need to start looking for. January is a great time to do it, but go ahead and start doing those this week so that you are prepared for next time. Okay, so where should you put your savings once you have it? So you want to weigh the benefits and the risks. So, for benefits, you want to kind of see what account has the best advantage for you. And you also want to make sure you're not putting your money into an account that has a lot of risks. Now, a lot of people like to go with their bank and they'll put a little bit of money in a savings account that's hooked up to their checking account. Now, why would you want to do that? So you would want to pick a savings account that hooks up to your checking account for something that we call overdraft protection. So if something were to happen, if you were to swipe that card and you didn't really know exactly how much was in that account, instead of going that big overdraft fee, it would just automatically withdraw that out of your savings. That way you are protected. Now, the benefits and risks of that one is you're not going to have a high interest rate. So a savings account that's usually hooked up to a bank, just a big bank such as Bank of America, Wells Fargo, you are not going to really have a high interest rate, and your money is not really going to earn that interest. So when you look at other banks, maybe money market accounts or maybe online banks such as maybe Ally or I think Capital One 360 has one. These are accounts that, since they don't have to, they're not connected to your bank, they have pretty much have a higher interest rate. So now, right now, with the coronavirus happening with the economics, that the interest rates are a little lower. So keep that in mind, but keep in mind that you do want to look for something with a higher interest rate. Now, the risk with that online savings account, as we mentioned, is it may take a couple of days to transfer those funds over. So for Ally, for example, is a really popular online savings account. It does take 3 to 5 days to transfer that money over. So if you need it in a true emergency, it may be harder to reach. Now, so that's why you might want to keep in mind, weigh the benefits, weigh the risks, and find what's best place to keep the savings for you. Now, you always want to make sure you have some sort of liquid savings, just in case something were to happen, you'd be able to access them very quickly. Some people keep that in their checking account. Some people keep that in their savings account. You just want to make sure that your money is where you can access it, but it can also give it more benefits for you. Okay, so this is another tool in our toolkit, which is finding a place for savings. So this goes through the benefits and risks of an account at a bank or credit union, benefits and risks to a family, entrusting your savings to a family or friend. So go through this toolkit after the session and just figure out the best way where your savings, where you feel most comfortable. Okay, so we will now launch into retirement savings, and I will go through the retirement savings in the next couple of slides. But in this session, we will be going over IRAs, Roth IRAs, 401k plans, 403b plans, and pension plans. So those are the ones that we covered today. If you have any questions for those, anything else in addition to that, feel free to let me know, and I will try to get that information to you. That way you are well informed. Okay, so I want to talk a little bit about traditional IRAs and Roth IRAs. So these are, and this is a little chart here, very easy to read. If you need this chart later on, let me know. I can email the slides to you. That way you have it. So for a traditional IRA, we'll go for that one first. So you can contribute, or your spouse, if you file jointly on your taxes, you can both contribute to a traditional IRA. And then you can deduct those contributions in your taxes. So this is our contribution limits for 2020. Those do change frequently, so you might want to check for 2021. So the contributions are the same for a traditional IRA and a Roth IRA. The deadline to make contributions is tax day of the next year. So for 2020, the deadline is not until April 15th of 2021. So if you're wanting to get caught up and wanting to get that max contribution here, you have until next April to make that happen. So feel free to know about that. Now, the only con about that is that if you do keep caving from 2020 into 2021, you may be behind on your 2021 savings. So just keep that in mind. You can withdraw money out of a Roth IRA and a traditional IRA. And then you must start taking those distributions by April 1st of the following year in which you turn 72. So you have that money. You may not want to pull that out right away, but as soon as you turn 72, the April after that, you will have to start taking distributions from that money. Now, are your withdrawals and distributions taxable? So this is important. So if you withdraw out of this, are you going to pay taxes on that money that you took out? So any on the traditional Roth IRA or traditional IRA, any deductible contributions and earnings that you withdraw that are distributed from your traditional IRA are taxable. So if you decide that you need some money and you want to take it out of that retirement account, you may want to consider that you will have to pay taxes on that money. So it may not be the best plan. This is a really great thing to talk about with your accountant or financial advisor to make sure that pulling money out of your retirement to pay off something else is a good plan for you, because you may end up paying more in the long run when you have to pay taxes on that income. So be sure to keep that in mind. Now, a Roth IRA are really great resources, especially if you are already contributing to a 401k plan with your employer and would like to invest more. A Roth IRA, you pay those taxes up front. So what does that mean? That means that you pay taxes on your contributions. These are after taxes. So when you withdraw, when you decide to take that money out when you have retired, you don't have to pay taxes on that money later. You've already done that. So no worries there. So Roth IRA, you can contribute at any age, or your spouse as well if you file jointly. If you have taxable compensation and your modified adjusted gross income is below certain amounts. So you may want to go look and make sure what your income is, and if it qualifies, you can just find that information online. So are your contributions deductible? Your contributions are not deductible. And then the contribution plan is the same as the traditional IRA. It's $6,000 if you are under the age of 50, and $7,000 if you're age 50 or over by the end of the year. A same kind of deadline for the contributions, but again, as we talked about earlier, you may want to make sure to make those contributions before 2021 so that you are not behind on your 2021 contributions. You can withdraw money at any time. And then you are not required to take these minimum distributions as the traditional IRA. You can leave that in the bank, the savings account, until you're ready to take it out. And are your withdrawals and distributions taxable? So not if it's a qualified distribution. So make sure to look that up on this website. I'll link the website below. The Roth IRA does have some distributions that are allowed to take it out. A big one that people use is to use a down payment. Use the money for a down payment, and there are some other distributions that are able to access that money without it being taxed. So be sure to check into that as well. All right, so a 401k. So when you get a new job and you would like to, you maybe get all this the first day, you have no idea what it is, it's really important to make sure to have this kind of very basic information so that you know how you can make these decisions. A lot of college students are coming in and they're starting their first job of employment and they're not really sure how to get this started. So this is a really quick overview of what a 401k is. So 401ks are only available through employee-sponsored programs. Some employers may impose a waiting period before enrollment, and no income limits apply. So with the Roth, there are some income limits. 401k, there are not. So you may invest your 401k with pre-tax dollars. And what that means is that your employer will take that contribution before taxes. So that keep in mind, that will lower your taxable income for the year, but you will have to pay taxes on any money that you withdraw at the age 59 and a half. So this may lower your taxable income. This does help you're able to claim as deductions, but you do want to keep in mind that you will have to pay those taxes later. You can contribute $19,000 per year, or $25,000 per year for those 50 and older, and those are called catch-up contributions. So this is a max that you want to hit. You can also keep contributing to that one as well for the next year. And many employers offer a match based on a percentage of your gross income. So you may hear when you join onto a company that they have a match, 401k match. What you would want to do if you are working on other goals right now, maybe you're working on paying off debt, you're working on building up that emergency fund, you still want to make sure that you contribute up to that employee match because you don't want to leave that money on the table. Employers are doing this. They want you to stay with them. They want to keep you as an employee. This is a benefit that they offer. So you want to make sure that you're contributing up to the employee match that they have elected to provide, so that you are making sure that money is accumulating in your account. Now, after you finish paying off debt, after you finish building up your savings account and you are comfortable, the kind of rule of thumb is to try to invest at least 15% of your income. So if you want to boost those contributions up, feel free to do that. Now you can boost that up to 15% on your 401k, or you can split that between a 401k and a Roth IRA or any other investment that you would choose to go to. So this is just a quick overview on a 401k plan. Now, a 403b plan. So these are very similar to 401k plans, but their participation is limited to employees of certain tax-exempt organizations. Now, these are your nonprofits. So they are tax benefits to making contributions to a 403b, and these are usually in the form of tax-free contributions. So contributions will apply, and again, it's similar to a Roth. Certain criteria must be met in order to withdraw from a 403b. Now, these are really specific, so you want to make sure to keep in mind, look at the different plans from your employer. If you are a nonprofit, you may want to look into this and know that you may be on a different plan than a regular 401k, and see what those contribution limits are and what criteria you need to meet in order to withdraw. Okay, so pension plans. So there are a couple of different kinds of pension plans. A defined benefit plan is an employer agrees to give retirees a specific benefit, which is generally a percentage of the final salary. So this formula is based on their employees' years of service and annual compensation, and sometimes your age. So they would kind of want to look at how long you've been with the company and what is usually your annual compensation. So this may be, I worked for a company for 25 years. My median salary was $50,000. So they will kind of look at that amount and figure out a specific benefit to give to you every month until you pass. So this is a defined benefit plan. Now, you also have a defined contribution plan. So this is when an employer agrees to make a fixed annual contribution to a pension fund. So this is a fund, the employer contributes 5% of the employee's pay, and they would then take that money and give it to you after you retire. So make sure to check with you if you work for maybe a city or work for any other company that does a pension plan, which one the employer has decided to go with and how that affects your retirement. Okay, so a health savings account. And so we'll touch on a health savings account. There's also a FSA, a flexible spending account, but we'll go on a HSA first. So a health savings account that is funded by an account holder and or an employer. So your employer may contribute a little bit of money into this account and then allow you to contribute a little bit of money in that account, and then it can grow over time. Now, the HSAs are so confusing because people refer to them as a triple tax advantage. Now, if you don't know a whole lot about savings accounts or know a whole lot about this kind of thing, that can seem really confusing. So a triple tax advantage basically means that you can contribute this money pre-tax, so you don't have to pay taxes on the money that you're contributing. So this is similar to a 401k. It then grows tax-free, so you can invest that money once you've contributed it. A lot of HSAs have a very minimum balance required. A lot of them is $1,000. Once you have $1,000 in the HSA, you could then start to invest it. That money can grow tax-free, and then when you spend it on qualified medical expenses, it's tax-free as well. So you don't have to pay taxes on the money as long as you take it out and spend it for medical expenses. Now, this is, when you get into the older years, you are going to have a lot more medical expenses. And over the years of your life, you're going to have medical expenses. I mean, you may be looking at child costs in order to make sure to have make sure your labor and delivery is covered. And you can also use the HSA for medications, a lot of different things that are HSA taxable. So you can make sure to look into that as well. But this is very, very, very great tool for you to use. Now, usually you can only have an HSA if you have a high deductible health plan. So make sure to check with your employer, make sure to see what health plan you are on, and if you are eligible for an HSA, you don't want to leave that money on the table. Now, an HSA also stays with the account holder after leaving your place of employment. So if you do move on and decide to go with a different employment, that money is still yours. It's still invested. You can still use it and you can still contribute to it. So make sure to keep that in mind. Make sure you're not leaving those dollars behind when you move employers. And again, at the very end, that final bullet point there, we did speak on that. Investment options after minimum balance has been reached. Be sure to check what that minimum balance is on your HSA account. That way you are ready to use it and make sure you are investing as well. Okay, so we'll talk a little bit about children's futures. So there's a couple of things that you can do for your children and make sure that they are well taken care of. Now you can do custodial accounts, an IRA, or a 529. So most accounts for your child can hold the same items that you hold in a normal brokerage account. So, since your child has time, a heavy allocation of stocks usually makes sense. Now let's touch on that really quickly because that is important, and I didn't touch on that earlier. So when you invest your retirement savings, it's really important to figure out whether you should invest more into stocks or more into bonds. Now, what are those? So stocks are usually a little bit more volatile. They do earn a higher income, a higher return rate. Bonds are usually more stable and they earn a lower return rate. So if you are younger, say you just graduated college, you're 22, 23, you want to start investing for your retirement, you still have a really long time until you need that money. You still have maybe, 40, 50 years. So I would say, and especially and we'll touch on children's again. So if you're investing really early, you have that time on your hand, maybe invest a little bit higher on stocks. You will get that higher return. And if the stock market does fall a little bit, you have time in order to build that back up. So, and if you're an older investor, maybe late 40s, 50s, and you would want to tap into that retirement sooner rather than later, you may go a little bit more on bonds because you don't want to risk that savings before you can access it. So you want to make sure that that's more of a safety, more of a comfortable investment. So if you go on, you're planning a custodial account or an IRA for a child, you may want to look more into stocks. And if you're doing it for yourself, and a lot of different kinds of investment, maybe if you look at Fidelity, Vanguard, look at those places, they will have a target date fund. So a little target date fund, a little bit about that is that if you would like to retire by a time that you are maybe 60, it will look at what age you are now, what year you would be when you turn 60, and it would already have a kind of nice little nest egg, a mixture of stocks and bonds. So, if you are, again, if you're a little bit younger and you're going to retire in 30 years, that 30-year fund is going to be a little bit higher risk than maybe a 10-year fund. So you kind of want to look at that. That's how you can kind of look and make sure you are investing in the right option. So for children's futures, a custodial account, this is an account that is in a child's name that you are the custodian of, a parent. So you can contribute to that. And then you can, once they turn 18, you can pass that money along to them. You can also open an IRA in their name and then pass that along as well to them. Make sure that they are set up for you for retirement, maybe if you pass. And then you have a 529. So a 529 is a college savings plan. So this is a little bit different. 529, some people are moving away from those because they don't feel like as we get a little bit more into the future, they don't feel that, children should have to go to college. Maybe they can want to go do it in trade instead. But those are also really good accounts to look at so that money can earn some more money. You don't really want that money sitting in a savings account for 15 years while your child is growing up. You want to make sure that you're making smart decisions with that money and making sure the benefits of that money are well received. So you want to make sure that money is still growing.